Something unprecedented just happened in the silver market that nobody is talking about. On the last trading day of 2025, silver prices exploded 11% in a single session, rocketing from $71 to nearly $80 per ounce. But here's what makes this absolutely extraordinary. At exactly 3:52 p.m. Eastern Time on Friday, December 27th, someone placed a $429 million bet on silver mining stocks, with most of the options expiring in just 3 weeks. 8 minutes before the market closed, 8 minutes before a weekend that would change everything. Within hours, rumors began circulating through trading floors that a major bullion bank had received a massive margin call on its short silver position and could not meet it. That same morning, banks tapped the Federal Reserve's emergency lending facility for over $17 billion in liquidity. Some reports suggest the real number was closer to $34 billion. By Monday, silver had gapped up from $72 to over $74 when trading resumed. As of today, January 7th, 2026, silver is trading around $77 per ounce, up a staggering 160% from where it started just 1 year ago. But this isn't just another price spike. This is the beginning of what many analysts are calling the Great Silver Squeeze of 2026. And the banks who spent years shorting this metal are now scrambling to cover their positions at any price. The numbers tell a story that Wall Street doesn't want you to hear. Silver entered 2025 trading at just $29 per ounce. By the end of the year, it had reached $81, a gain of approximately 180% in 12 months. This makes silver the best performing major commodity of 2025, outpacing even gold's impressive 66% return. Gold itself had its best year since 1979, but silver absolutely crushed it. If you had purchased silver in September 2025, you would have doubled your investment in just 4 months. Think about that for a moment. In a world where investors are told to expect 7 to 10% annual returns from the stock market, silver delivered 180% in 1 year. But the real story isn't just about past gains. It's about what's happening right now in the physical silver market, and why the paper price that we see on exchanges may be completely disconnected from reality. The London Bullion Market Association reported in October that its vaults held 844 million ounces of silver, equivalent to 23,126 tons. Yet when buyers showed up demanding delivery of just 1,000 tons in late December, the market couldn't provide it. How is that possible? Because 4/5 of that stockpile is registered to various ETFs and not available for immediate delivery. Some of those bars may have been leased out to banks multiple times over, creating claims on silver that doesn't actually exist in deliverable form. The scale of industrial demand is staggering. In 2024, industrial fabrication demand reached a record 680.5 million ounces, and that momentum accelerated through 2025. Industrial applications now account for more than half of all global silver demand. The solar energy sector alone consumed 29% of industrial silver by 2024, up from just 11% in 2014. Each photovoltaic panel contains 15 to 25 grams of silver, and the newer TOPCon solar technologies require up to 50% more silver than traditional panels. The International Energy Agency projects that solar capacity will quadruple by 2030. The European Union aims to deliver 700 gigawatts of solar capacity by 2030. When you do the math on how much silver that requires, the numbers become almost incomprehensible. The solar sector alone could consume 300 million ounces annually by 2030. Electric vehicles are the other massive demand driver. A traditional gasoline car contains 15 to 28 grams of silver. A battery electric vehicle uses 25 to 50 grams, nearly double. With global EV production expected to reach 15 million units in 2026 and potentially double again by 2030, this sector represents exponential growth in silver consumption. The Silver Institute estimates that automotive silver demand will increase at 3.4% annually through 2031, with demand from EVs overtaking internal combustion engines by 2027. Then there's artificial intelligence and data centers, a demand source that barely existed 5 years ago but is now exploding. Total global IT power capacity increased by 5,252% from 2000 to 2025, jumping from less than 1 gigawatt to nearly 50 gigawatts. This translates directly into vastly more computing hardware and dramatically greater silver demand. Each AI server relies on thousands of high-performance connections, where silver's superior conductivity is essential. A single 500 megawatt solar array capable of powering one hyperscale data center requires around 300 metric tons of silver. Data center power requirements are projected to double by 2026 and quadruple by 2030. Governments worldwide are prioritizing data centers as critical infrastructure, rolling out grants, tax breaks, and fast-track approvals to attract investment. Every data center that gets built increases structural demand for silver, and this demand is price insensitive. Tech companies building AI infrastructure cannot substitute copper or aluminum when performance is critical. They need silver regardless of cost. Here's what makes the supply situation truly dire. Silver mining is fundamentally different from gold mining. Most silver isn't mined directly. About 72% of primary silver production comes as a byproduct of mining for other metals, primarily copper, zinc, and lead. This means silver supply is largely dependent on the economics of base metal mining, not silver prices. Even if silver prices double or triple, it doesn't automatically bring new silver supply to market because miners are making decisions based on copper or zinc economics. This creates a unique situation where even substantially higher prices cannot quickly increase supply. Making matters worse, new mining projects take 8 to 12 years to develop from discovery to production. Ore grades are declining globally, meaning miners have to move more rock to get the same amount of silver. Recycling contributes roughly 180 million ounces annually, but that figure has remained stagnant for years. Much industrial silver consumption is effectively non-recoverable because the quantities in individual electronic devices are so small that it's not economically viable to recycle them. The silver market has experienced a structural supply deficit for 5 consecutive years from 2021 through 2025. The cumulative deficit over this period approaches 820 million ounces. Mine production has consistently lagged behind consumption, and new significant mine production is not anticipated until 2027 or 2028 at the earliest. This isn't a temporary imbalance that will correct itself. This is a structural shortage that's getting worse, not better. The United States government designated silver as a critical mineral, recognizing its strategic importance to national security and economic competitiveness. When governments start treating a commodity as strategically critical, it signals genuine scarcity concerns. Visible inventories are collapsing. COMEX registered silver inventories in the United States are down nearly 70% since 2020. Shanghai stockpiles dropped by over 1,000 tons in just 3 months, representing 2/5 of total available inventory. Both Western and Asian vaults have been drawing down metal at a historic pace. Every major silver vault in the world is being drained simultaneously because buyers increasingly want physical metal, not paper promises. This brings us to the most explosive part of this story, the banks and their short positions. For decades, major banks maintained massive short positions in the silver futures market. A short position means they sold silver they didn't own, betting the price would fall so they could buy it back cheaper and pocket the difference. This worked brilliantly when silver was trading at $15, $20, or $25 per ounce. Banks would short the market, suppress rallies, and profit from sideways or declining prices. But something changed in 2025. The fundamentals became so overwhelmingly bullish that no amount of paper selling could hold prices down. When physical buyers showed up demanding delivery and there wasn't enough metal to meet contractual obligations, the entire system started cracking. Social media and alternative financial sites exploded with reports that Bank of America was short 1 billion ounces of silver and Citigroup was short 3.4 billion ounces. To put those numbers in perspective, total global annual silver production is only about 800 million ounces. If those short position numbers are even remotely accurate, these banks sold 5 times the planet's annual silver output, betting on prices going down. Instead, prices nearly tripled. The mechanics of what happened in late December reveal the desperation. On December 27th, silver prices surged 11% in a single trading session. That kind of move creates immediate margin calls for anyone holding short positions. A margin call means your broker demands you deposit more cash immediately to cover your potential losses. If you can't meet the margin call, your position gets liquidated forcibly. The broker buys silver at market price to close out your short position, regardless of how high that price is. At 8:30 a.m. on Friday, December 27th, major banks tapped the Federal Reserve's repo facility for between $17 and $34 billion in emergency liquidity. The repo facility is essentially emergency lending, where banks put up collateral to get immediate cash. From early July 2020 until Halloween 2025, there were virtually no such emergency cash infusions. Then suddenly, on Halloween, banks needed $51 billion. The cash infusions from late December equaled that amount. These huge emergency lending operations don't happen during normal times. They happen when banks are facing liquidity crises and need cash immediately to meet obligations they cannot cover with their available funds. Later that same Friday afternoon, rumors exploded through trading floors that a large bullion bank was unable to meet a massive margin call on its short silver position. If true, this would mean the bank's short position would be forcibly liquidated, with unrealized losses immediately marked to market. Then came that mysterious $429 million bet on silver mining stocks at 3:52 p.m., 8 minutes before the market closed. The timing is extraordinary. Someone with deep pockets made a massive directional bet that silver miners would soar, right as rumors circulated that a major bank was being forced liquidated out of its short position. If that bank knew its legacy short position was about to be liquidated, and knew this would trigger a massive short squeeze. Placing a huge long bet on silver miners would be one way to offset catastrophic losses on the short side. The Chicago Mercantile Exchange responded to the chaos by raising margin requirements on silver futures to $25,000 per contract, a dramatic increase designed to reduce speculative leverage and prevent market collapse. Exchange officials called this a routine action to ensure market liquidity. But margin hikes of this magnitude are not routine. They happen when exchanges fear systemic risk. Now here's where it gets really interesting. The New York Federal Reserve removed limits on how much emergency cash it will provide to the banking industry. Previously, there were caps. Those caps are now gone. Individual banks can now access between $80 and $240 billion per day in emergency lending, depending on how you interpret the Fed's announcement. Why would the Fed suddenly remove all limits on emergency bank lending unless they feared a systemic crisis? The opacity of these operations raises serious concerns. The Fed does not identify which banks are receiving emergency funds. Markets and the public cannot assess who is exposed or how concentrated the risk is. This is exactly the kind of hidden leverage and interconnectedness that triggered the 2008 financial crisis. Some reports claim JP Morgan Chase closed or dramatically reduced its short silver position earlier in 2025, flipping to a net long position and profiting from the rally rather than suffering from it. If true, this would be a brilliant trade. JP Morgan accumulated physical silver while closing paper shorts, positioning themselves to profit massively from the squeeze they knew was coming. Other banks weren't so smart or so quick. The critical question is what happens next. The current paper to physical ratio in silver stands near 356 to 1. That means for every 1 ounce of physical silver that actually exists in deliverable form, there are 356 ounces worth of paper claims circulating in global markets. As long as investors are content to hold paper exposure through ETFs and futures contracts without demanding physical delivery, this system can function. But if even a small fraction of participants demand physical delivery, the market faces a catastrophic short squeeze where there simply isn't enough silver to meet contractual obligations. This structural fragility is now being exposed. Market makers are stepping back, liquidity is thinning, and volatility is spiking as trust in the paper system erodes. Silver prices are not just reacting to supply and demand fundamentals anymore. They're reacting to the realization that the market's underlying structure may not be credible. When paper promises cannot be converted to physical metal on demand, the paper becomes worthless. Only physical silver holds its value when the system breaks. We're already seeing signs of market fracture. In early January 2026, spot silver trades around $74 to $77 per ounce on COMEX. However, physical premiums in Shanghai remain elevated at $78 to $80 per ounce equivalent, reflecting a persistent $5 to $8 premium over Western benchmarks. This price divergence highlights stress in the system. The Eastern markets, where physical delivery actually happens, are pricing silver significantly higher than Western paper markets. This decoupling between physical and paper prices is exactly what happened in lithium and rare earth markets when physical shortages emerged. Once physical delivery becomes the benchmark for price discovery, traditional futures exchanges like COMEX may lose control of global pricing altogether. Some major financial institutions are now revising their silver forecasts dramatically higher. Bank of America predicts silver will reach $65 per ounce in 2026, with an average of $56.25. Given that silver is already trading above $77, the market has exceeded even the bullish peak forecast from one of the world's largest banks. UBS increased its forecast by $5 to $8 and now expects $60 with potential spikes to $65. Citigroup projects $62 in baseline scenarios and $70 in bullish outlooks. These are conservative institutional forecasts. More aggressive analysts see much higher targets. Robert Kiyosaki, author of Rich Dad, Poor Dad, stated that $75 is achievable and suggested $100 or more is on the horizon. Felipe Geisels of BNP Paribas told CNBC he would not be surprised to see silver well north of $100. Some technical analysts suggest a scenario of $100 to $200 by early 2026, based on historical patterns where silver demonstrated the ability to significantly overshoot during periods of monetary stress. In the 2008 to 2011 period, silver prices increased 431% as investors fled to hard assets during the financial crisis. Today's backdrop of structural deficits combined with unprecedented monetary expansion arguably rivals that earlier period. The Federal Reserve cut interest rates 3 times in 2025, making cash and bonds less attractive relative to hard assets like precious metals. But more importantly, the Fed signaled what's being called the resumption of Treasury buying, though officials are very careful not to call it quantitative easing. Reserve purchases will amount to $40 billion in the first month and may remain elevated for months. Macro Maven's president Stephanie Pomboy explained this perfectly. She said the balance sheet will become the main source of monetary stimulus, and balance sheet expansion is outright monetary debasement. There's nothing better for precious metals than currency debasement because precious metals cannot be printed or created at will. The US dollar had its worst year since 2017, down over 6% in 2025. A declining dollar makes dollar-denominated commodities like silver cheaper for foreign buyers, increasing global demand. The combination of lower interest rates, balance sheet expansion, and a weakening currency creates an almost perfect environment for precious metals. Ola Hansen of Saxo Bank described this as a broader trend away from the US dollar toward precious metals. In an increasingly fragmented world, the weaponization of markets, payment systems, and reserve assets has eroded confidence in traditional safe havens like the dollar. There are also growing concerns over Federal Reserve independence. President Trump's threats to remove Fed Chair Jerome Powell and the recent firing of Governor Lisa Cook have raised serious questions about the institution's credibility and long-term stability. If confidence in the Fed's independence continues to erode, it would represent another significant hit to the dollar's reputation as a stable, rule-based currency. Silver, which combines monetary hedge appeal with robust industrial demand, would be exceptionally well positioned to benefit from any loss of trust in central banking institutions. The risks in this market are substantial and need to be understood clearly. Silver is highly volatile, with historical drawdowns of 30 to 50% possible even during major bull markets. The most significant near-term risk would be an unexpected Federal Reserve policy reversal. If economic data comes in much stronger than expected, forcing the Fed to pause rate cuts or even increase rates, real yields could rise substantially. Higher real yields make cash and bonds more attractive relative to non-yielding assets like silver, potentially triggering significant selling pressure. A rapid strengthening of the US dollar could also pressure silver prices, despite favorable long-term fundamentals. A global manufacturing slowdown would reduce demand from electronics, automotive, and construction sectors, though the renewable energy build-out appears to be a multi-decade trend driven by government policy rather than pure economics, providing some insulation from normal downturns. There's also technical selling pressure coming from index rebalancing. Silver futures currently make up 9% of the Bloomberg Commodity Index, compared to a 2026 target weighting of just under 4%. This means over $5 billion of holdings need to be sold during the roll period, which some strategists warn could cause dramatic short-term repricing lower. However, if physical market fundamentals remain as tight as they appear, any such technical selling would likely be viewed as a buying opportunity by longer-term investors and industrial users who need physical metal regardless of price. Despite these risks, the fundamental case for significantly higher silver prices appears stronger than the case against. The renewable energy transition is a multi-year trend with strong government backing worldwide. As nations continue prioritizing decarbonization and electrification to meet climate commitments, silver consumption in solar panels, electric vehicles, and related infrastructure should remain structurally elevated through the entire decade. Supply remains fundamentally constrained. Given the long lead times for new mine development and silver's nature as primarily a byproduct of other mining, even substantially higher prices are unlikely to bring significant new supply to market for years. The paper-to-physical ratio of 356 to 1 is unsustainable. As more investors and industrial users demand physical delivery instead of accepting paper claims, the system will experience increasing stress that can only be resolved through much higher prices, or a complete restructuring of how silver is traded and delivered. The monetary backdrop with central banks maintaining accommodative policies should continue supporting precious metals generally. If geopolitical uncertainties persist or intensify, which seems probable given current global tensions, real yields could remain low relative to historical norms, creating favorable conditions for assets like silver that provide insurance against currency debasement and political instability.